Good afternoon, everyone. Thank you for joining us for today's webinar discussing tax and employment law considerations for dealership executives as they relate to the current landscape we find ourselves operating in with the impacts of COVID-19. My name is Chris Shifley, and I am a partner with M&P's Surrey office and the BC lead for dealership services at M&P. I work with business owners in the automotive industry to provide assurance, tax, and business advisory services. Joining me today for the presentation is Ken Robinson and Danny Bernstein. Ken is a partner with M&P's Port Moody office and is part of the specialty tax team. Ken is involved with the delivery of a full range of tax services, including acquisitions and divestitures, estate and succession planning, advanced remuneration strategies, and tax reorganizations. Danny is a partner at Roper Greyell, where he practices in all areas of labor and employment and human rights law. His areas of expertise include wrongful and constructive dismissal claims, human rights complaints, statutory entitlement claims, complex human rights and accommodation issues, negotiating or litigating terminations, layoffs, and performance management. If you have any questions as we go through the presentation, please type them in the chat box on your screen. We have a team monitoring the chat in the background, and any questions for the Q&A segment of our presentation will be pushed through forward to the group. Please also note that this presentation is being recorded for your later review. We'll provide a copy of the recording within a handful of days. Now I'll pass the floor to Danny for his presentation on COVID-related employment law.
Hi, and thanks, Chris, for the introduction. Welcome, everyone. Thank you for joining us. I will be dealing with some select topics on employment law considerations that you probably have already experienced and may anticipate experiencing. I know we've all been bombarded with information from various government departments, federal and provincial, around some changes to the laws that we've all been experiencing. So I'm not going to do a deep dive on anything in particular. I'm just going to focus on two topics here, being government directives, which we've all heard, and then managing employees during and after COVID. And I think we're all starting to look at what managing employees after really looks like now, and after being, I guess, can include currently as we return and reopen, and then after as things continue to normalize somewhat. But I don't think we're truly going to be outside of the pandemic for some time. I'm not going to give you an overview of everything because it's too broad. I'll focus on these couple of topics. Within government directives and resources, a couple of things to really bring your attention to that I think are important. When the pandemic first really hit our screens and government started acting, one of the first things to change was this introduction of a new leave provision under the Employment Standards Act. And this granted protection to employees who needed leaves of absence for COVID-related reasons, and I've listed them on this slide here. And this was really a first step at protecting employees so that they could get leaves that they needed to either stay home because they were isolating, they were told to stay home for either fear of contamination of themselves or others, if they had to care for someone at home, or if indeed they were sick and showing symptoms of COVID. So this was just a first foray by the government, in British Columbia government, to protect them, and it was mirrored around the country with various provincial governments changing their employment standards. The leave is set to continue for as long as the circumstances which created the need for the leave exist. So it differs depending on why the leave was required. Example, if you were in self-isolation for 14 days, well, the leave extends for 14 days. If you are caring for a child because of schools being closed and you have no other alternatives, then the leave will continue longer. And I think this is going to be really important to consider when we start to look at reopening. I'm anticipating one of the challenges that's going to arise is employees saying, I can't come back to work either at all or in the same way because of A, B, and C reason, and employers will have to look at this list and consider, is the reason given one of these protected leaves? And if it is, how am I going to manage this? There's a concept that the employer can also ask for reasonable proof, but you'll remember right at the outset there was a very strong discouragement of going to a doctor. So I think it will depend on the circumstance for what proof you look for. And these leaves, I imagine, will remain in the Employment Standards Act until quite some time after this pandemic subsides. The next piece that I wanted to look at, and this is really key because this has just happened and it's a date that's coming up, is this extended temporary layoff period. I'll talk in a little bit about the rules around layoffs, but I think we've all heard and experienced or thought about how long this temporary layoff, if you've indeed had to lay off staff, how long it's going to last. And originally our Employment Standards Act said you could lay someone off for 13 weeks in a 20-week period. And at the expiry of that 13 weeks, the Employment Standards Act deems employment to have been terminated. So an employee is entitled to their statutory termination pay. Now that was extended to 16 weeks. I think it was extended either Friday last week or Monday of this week. So employers have an extra 3 weeks. The thinking, I guess, behind that was to coincide with the announcement around reopening, the hope being that with a few additional weeks, employers can recall people to work, and a lot of employers are doing exactly that in conjunction with the SUS, the wage subsidy that they're entitled to, and Chris and Ken are going to talk a lot about, or at least in some detail around SUS, but we've all heard of it. We all know if you've experienced that requisite decline in revenue, you can access some funding for employee wages. So our employers are using those funds to recall people to work to avoid this deemed termination. You've got a little bit of extra time here. You'll see on the slide there's a note saying there's some practical considerations, and this is just food for thought, that it's only the Employment Standards Act that says if you exceed the temporary termination period, employment is deemed terminated. And that, in order to trigger that, in my view, requires an active step. An employee has to come to you and say, okay, I am now terminated, you owe me my termination pay. Or the employer goes to the employee and says, look, we're not going to recall you within this time, and therefore we owe you your termination pay and we are terminating your employment. I think there's a bit of a gray area, which I'm sure we will experience, which is employee doesn't make a claim, employer doesn't act to terminate, and sometime after the deemed termination period, deemed termination date, there's a recall, and the employee's happy to come back to work. And it's a grey area because I think there's still a risk that that person is owed their statutory termination pay, but I think there's a very real practical consideration as to whether they will actually claim it, or will the relationship just restart and there'll be no consequence for the employment to have been deemed terminated. So I guess the takeaway there is don't rush to assume that you have to pay up termination pay if it's not claimed, or if you don't want to. Give some thought to if you're prepared to accept that risk and what your relationship is with your employees, and maybe do a case-by-case analysis as to whether that makes sense. Okay, moving on to the next government directive, and this is the restart plan that we heard about on Wednesday. Everyone, I'm sure, by now has given that some thought. It details a series of phases where the economy can reopen and what businesses can reopen and what that looks like. Those of you who have repair facilities, you would know that you're already an essential service, so there was no forced closure. Others with retail may have been operating on a greatly reduced basis, maybe not at all. It's very difficult to have a work from home environment in a true sense, depending on the style of business that you have set up. What we're hearing is that there's going to be a need when reopening to look at what your plans are, what your basically COVID management plan from a health and safety perspective is going to be. We're hearing that WorkSafe BC is going to be heavily involved in assessing those plans, in visiting businesses, doing safety analysis to decide if the business is sufficiently equipped to reopen. And that will depend on the retail floor. It will depend on the shop floor, the space available. There will be a range of considerations to look at. On my next slide, you'll see I've got a quote taken directly from the government's restart plan website, but they're mentioning the need to look at new sick leave policies, new health and safety policies, because there's a strong encouragement for employers to allow employees, well, let's put it in a different way. Employers are going to have to tell employees not to come to work when they're sick. There will be, I think, a zero tolerance on anyone who attends at work with any sort of symptoms. The usual cold symptoms that we would have tolerated previously, I don't think can be tolerated anymore. And so there's going to be pressure on employers to allow sick leave, which raises the question as to whether that's paid sick leave or not. It'll be interesting to see if the BC or federal government does anything about any EI waiting periods for EI sick leave, because a lot of employers simply won't be in a position to pay that additional sick leave. It'll be a considerable extra cost. But nonetheless, I think businesses will need to review what their sick leave policies do say on that topic and consider if they need revising. And same with health and safety. We never contemplated social distancing in our health and safety policies, or plexiglass screens, or in additional hand washing and other other such physical measures. So those are all the things that employers will have to look at, I think, and build into a restart plan, and build into either written policies or procedures. I think I read somewhere that companies or businesses may even need to publicly show what their COVID plans are, so that any member of the public accessing that business can see what they're doing and decide whether it's sufficient for them and their own risk tolerance. So lots to consider, lots to think about when looking at reopening it in any real way. There's going to be, I think, a lot of heavy lifting that needs to happen before the public comes back and before we can properly reinstate our businesses. This was the link or quote I said. This is directly from the BC government website, where they've got set out their plan. They're talking about having to create clear workplace policies, ensure people do not come to work, and this is a sick leave piece. It's really going to be interesting to see if there's any forced paid sick leave on that point. Working from home options where possible. If not, looking at staggered shifts, virtual meetings, basically getting people out of face-to-face interaction as much as possible. Reducing the intensity of contacts. I'm very curious to see, and you guys will have to think about this, but when someone's looking for a new vehicle, obviously there's a test drive. So how are you going to manage? Is there a salesperson in with them? And if there's not, what's the cleaning protocol? That is obviously a very confined environment. Same with a workshop where you've got a number of people, perhaps by necessity, working in close quarters. You'll have to give a lot of thought to how that's going to be managed. And then high-risk employees, we're going to have to look at accommodation cases where people are either themselves high risk or whether they've got family who is at high risk. Moving on then to the concept of managing employees, and we talked a little bit about that in that sort of speed through some government directives there. Implementing, managing, ending layoffs, changing terms of employment. This is probably something you've all been dealing with already. I'm sure the vast majority have had to implement layoffs, and then now we're looking at ending them, or what do we do during periods of layoff? Layoffs are an area where I think the law has shifted, or where the practice has shifted a lot. Prior to COVID, layoffs in industries that weren't unionized were generally unheard of. And the law was very clear that if you didn't have a contractual right or the employee agreeing to it, you couldn't generally lay someone off. And what we've experienced here is that employees have very much got on board with employers asking them to accept layoffs rather than terminations. So that was the law as it was. A layoff ends when there's either a termination of employment because the employee will not be recalled, or the employee is recalled to work. And a lot of employers are using the SUs to recall their employees, avoid that deemed termination date. And so that ends the layoff. And then there's a question of what to do with people who refuse to return to work. That's why I said it was important to consider the ESA Section 52.12 protected leaves. If you have people who are refusing to return to work and they are claiming a protected ground, either on a human rights accommodation basis or an employment standards basis, then it may not be that there's the same consequence as opposed to an employee who simply says, look, I'm getting the CERB, I'm pretty happy, I don't really want to come back. I don't think that's an adequate position, and that employee may indeed abandon their employment and end up losing their job and being disentitled to any government benefits. So when you are recalling people, you're going to need to look carefully at any refusals and the reasons for them. And the last point I've got here is to document everything. So depending on how you're going to manage recalls, I strongly encourage you to have everything documented. A letter, an email asking regarding the recall, even if it follows a phone call, document it so you know exactly what was covered. Another point to consider is if you are recalling people, are you going to need to change their terms of employment? The law says that an employer cannot unilaterally change a fundamental term of employment. So you can't insist on your employees working half-time or 0.7 or every other day. It needs their agreement. And prior to COVID, it was very difficult, generally speaking, to get that because a full-time employee worked full-time. They didn't bargain on working 0.6. We've had a shift in the mindset, I believe, because people are prepared to accept the changes in terms. Again, something you need to document very, very clearly. If you are recalling someone, I suggest a recall notice that says we are recalling you as of X date. And to be clear, the terms and conditions of your employment are going to change in the following ways. And do you accept this recall notice? And then therefore you've got an agreement to the change terms, you've got it documented. You shouldn't then later have a claim of constructive dismissal where an employee says, well, you changed my terms, because you've got their agreement. Generally speaking, the law says you can reduce someone's compensation by up to 10% without it being a constructive dismissal. A lot of employers in any industry, as a result of COVID, just very quickly implemented an across-the-board 10% wage reduction. And that generally is not considered constructive dismissal. Anything beyond that is, and you have to think about in terms of your commission plans, if you're going to change structures there, what the impact is, and build that into the decrease, because it's not just pure wages, it's an overall compensation analysis. And if you're changing your commission plans, which applies particularly in this environment, it's not whether there's an immediate impact or a long-term impact or the potential for improvement in the long term. An employee is entitled to assess the reasonableness of that change and whether they're going to accept it or not. So the key takeaway here, I think, around recalls from layoff and returning to work is, again, document everything and get agreement to any changed terms and conditions of employment so that you mitigate any constructive dismissal risk. Last piece here, my firm and my colleagues, we've been thinking pretty hard around what's coming next. What are we going to see? I've talked about people refusing to come back to work. Maybe they're scared of contracting COVID. Maybe they're scared of family members, or maybe they just got comfortable in their current state and they don't want to come back. You're going to need to look at accommodating employees who have high risk themselves or family members. Employees may say, look, I'm better off at home on CERB than I am in this part-time return to work. So that's, I don't think, reasonable, but something I think you're going to see. I do think we're going to see a lot of challenges down the line on people saying, I never agreed to a layoff, or I was pressured into it, or I didn't understand. Same with changing their terms of employment. I think the plaintiff employee side has been very quiet so far and biding their time to see things pick up a little before we see, I think, a big influx of claims there. And one thing to consider, a question I've got quite a bit, is how do I choose who comes back, and can I indeed choose? That'll depend on any policies you have, but generally speaking, you don't need to follow a seniority system. You can choose by business reasons, so long as you don't choose based on discriminatory grounds, the obvious ones being you wouldn't choose based on age or sex or any other prohibited ground. And always think about the optics, even if it's not a reason. If you've come up with some criteria, but it ends up that of the people being recalled, the majority of them are men, for example. Just think about the optics of what you're doing. I think I know that's a whirlwind, and I'm anticipating lots of questions coming in, and I'll address them after Chris and Ken, but that's what I wanted to cover. Thanks again. If there's something I can't cover in your questions, then my contact details are here, and do feel free to reach out. I'm happy to have an off the clock, if you will, conversation to follow up on any questions. And that's it. I'll throw it back to Chris.
Great, thanks, Danny. So now we will move on to the discussion of some financial matters that relate to the COVID situation. Areas that we'll touch on include gaining an understanding of the current situation and its impacts, some thoughts and tips around cash flow and cost management as we move slowly into the recovery phase, a brief overview of the various government support programs available to your organizations, and then Ken will discuss some of the tax planning opportunities that might be available to you to either help minimize current or ongoing tax burdens in light of the current pandemic. So the first thing that we need to understand as part of this situation is the impact on consumer demand. As I'm sure you've all likely noticed, there's been a dramatic shift in consumer demand since the onset of COVID-19 towards urgently needed items or essentials. While that doesn't necessarily mean that demand for vehicles, parts, or service has disappeared, but demand has certainly been altered and is being manifested in different ways. While certain purchases may have been put off by consumers, in most cases the potential sale will still be available, at least at some point. As we begin to move into recovery from crisis phase, the hope is that the pent-up demand for auto sales begins to ramp up again. We'll explore some of this as we move throughout the presentation. So the largest felt impact from the current situation in the near term will undoubtedly be on cash flows. There's no doubt that while your business may or may not remain profitable, there's a real risk of running low on cash. Now, this is true, of course, during normal times, but is even more possible during a crisis. The key is to know where your pressure points are and be prepared for them. The focus in the automotive industry should be put into cash, liquidity, and cost management, along with inventory management. The first thing your organization should be looking at, if you haven't already, is to prepare a detailed cash flow forecast. Now, this forecast should look at a cash flow in both the immediate term, a week to a few months, the near term, 2 to 6 months, and even longer. Consider all the possible inflows of cash that your organization anticipates in the coming weeks and months, and compare that against the related outflows. If any of these outflows relate to non-essential or discretionary items, you may consider suspending or deferring them immediately if you haven't already done so. Then the next step is to compare the two columns and identify any problem areas or potential shortfalls. After that, you can look to identify areas to bolster your inflows or reduce or defer the outflows. So first, let's have a look at some considerations that could impact your inflows of cash. Have you been reaching out to your key customers, leads, or referrals? If not, you probably should be. While those individuals may or may not currently be stepping foot in your physical dealership, they may still be interested or may be needing your products or services. Are you set up to transact with your customers electronically? If not, you may consider it. While there's not been much interest in shopping digitally in the auto industry in the past, this trend is rapidly and necessarily shifting. Are you set up for contactless service? even after operations begin to ramp back up, there's a very real possibility that contactless service will either be a requirement or a strong customer preference, or both. Another consideration to keep in mind is the customer's ability to access capital. While prime Bank of Canada rates have been dropping to historic lows, consumers may or may not necessarily be seeing corresponding shifts in their available rates. They may be having a harder time accessing capital based on banks shifting their risk profiles. So we should consider how this might impact your ability to close the deal. So the next step in analyzing cash flows should focus, of course, on the outflows. Now is the time to reassess your costs, your activities and projects, and determine which can be deferred or canceled. The key to sustaining your operations, should a cash crunch develop, will be to prioritize your most important suppliers and time your payments accordingly. You should be aware of who's offering payment deferrals and take advantage of them, while at the same time, make sure to reach out to suppliers and see what arrangements can be made. In the environment we're in, remember that it's wise to be in frequent contact with your suppliers to see what they're able to do that can help you sustain your operations. Another important area of focus for the auto dealer should be on their lenders. Now, if you're not in regular contact with your lender, it's likely a good idea to do so. Be aware of what your lender is offering in terms of deferred or reduced curtailments on your floor plans or other payments, as well as the bank's position on reporting timelines and their covenants. We've definitely been seeing the lenders being willing to be reasonably flexible on this front, but don't take that for granted, and do make sure to be in contact with your account manager for a conversation and get an understanding of their specific position. Also, make sure to be aware of any modifications to your key lending rates if that's applicable. So undoubtedly, one of the keys to success is going to be effective management of inventory in the coming weeks and months. Dealers will, of course, need to be acutely aware of any current or pending supply chain issues, depending on the manufacturer or manufacturers that you're dealing with. Of course, the question will be, will you have access to the inventory you need to meet your customers' demands? On the flip side, will you have the ability to control or decrease the level of inventory you're carrying for units that might see lessening demand? Used inventory will be another area of challenge given the current trend of decreasing values. And specific attention should be paid here and will need to be paid going forward in the used inventory costing and the pricing to ensure that your vehicles continue to be carried at the proper values as we move forward. Should your organization find itself or expect to find itself in a position of being short on cash, which can't be offset by spending cuts, now is definitely the time to start looking for solutions. There are several programs available through the BDC, EDC, as well as your current financial institution, which are designed to rapidly inject capital into organizations that may need it. So you've got 3 programs shown up on screen right now with access to loans ranging from $40,000 to $6.25 million. Some programs may or may not be available to your dealership depending on your organization's size. Now, if this is something you anticipate needing, I would encourage you to investigate options sooner than later. Do remember, of course, that if you wait until your cash runs out to start looking at these options, it's likely too late. Do feel free to reach out to your M&P advisor or your lending institution or the BDC as applicable to get more information on any of these programs. Now, one of the biggest and arguably most important areas of focus since the onset of the pandemic has been the support and deferral programs being offered by various levels of government, be that federal, provincial, or local. The Canada Emergency Wage Subsidy, or CEWS for short, is probably the most widely reaching corporate support program. Now, under the Qs, businesses who are impacted by a decline of revenues of 15% in March or 30% in April and May can apply for a subsidy of up to 75% of the employee's wages to a maximum of $847 per week per employee. A few things to note on this program include the ability to apply either on a standalone basis or a consolidated group basis. Now, this consolidated group basis could be beneficial if you find yourself with an entity that otherwise wouldn't qualify, but your group as a whole would qualify based on its revenue declines. Also, another note is that eligible remuneration under this program includes commission. Those paid after March 15th are considered eligible wages during the eligibility period, but do keep in mind that they qualify based on the period they are in respect of. What that means is that it's included in the period where the deal is completed, not when paid, if those two dates are different. There's different rules for the pre-crisis eligibility period as well, so just be careful as you wade your way through those various items. One important note is that if your dealership is eligible for the previously announced 10% temporary wage subsidy, keeping in mind that a lot won't be based on your size, but if you are, your claim under Qs must be reduced by that 10% subsidy amount, and that's regardless of whether you've claimed it or not. There are also complications around the inclusion of individuals who have been off work without pay for 14 days or more. Essentially, an employee becomes ineligible for the subsidy if they've been off work for a period of 14 days or more during any specific claim period. I would definitely recommend seeking input or guidance if you've got employees in this situation that you feel might otherwise qualify. Overall, this program is, it does have very complicated legislation behind it, and there are significant penalties and fines involved associated with false or incorrect applications. So I would recommend, paying close attention to your calculations, consulting with your M&P tax advisor prior to the submission of your application, whether it's just that you have questions or would like to review your claim. Just recently announced here, the Qs program was originally scheduled to end on June 6th. The federal government did announce today that the program will continue beyond this date. So stay tuned for more information on what that might look like. There's a few other government programs and measures listed on the screen that you'll see right now. There's a deferral of corporate tax payments. So any Part 1 tax payments due after March 15th have now been extended to September 1st. Your GST payments have been extended through to June 30th. And there's been a deferral of PST and employer health tax premiums through to September 30th. Of course, do keep in mind these are strictly just deferrals. They're not waivers of payments or anything in that regard. So do plan this into your cash flow forecasting that on these specific dates, these payments are going to come due again. Several jurisdictions have also deferred payment deadlines for property taxes. So do consult with your city or with an M&P property tax advisor on what that might look like given your city and your current situation. The last item you'll see there on screen is the federal government's Canada Emergency Rent Assistance Program. Now, we do continue to await clarity and guidance on this program. There's a lot of ambiguity and questions that remain surrounding the information that the government's released to date on this one. Based on the information that's currently available, the program proposes to reduce rent for small business and medium business by up to 75%. However, it does definitely remain unclear on how the definition of small or medium business will be interpreted and how that will apply in the context of a dealership, whether they will qualify and so on. So do stay tuned for more information on this one as the government continues to release it. And as I already mentioned, on all of these programs, the rules and legislation do tend to be fairly complex. So make sure you're consulting with your tax advisor before you make any applications to these programs. So in addition to what was included on the previous slide, there's a number of filing deadline changes that have been made. A few of the key ones are shown on screen here for you. The main one of interest is likely the corporate tax return filings. Those are normally due to be filed 6 months after year end. Under these extensions, any returns that would have otherwise been due between March 18th and May 31st have currently been extended to June 1st. Personal tax filings that would otherwise have been due on April 30th have also been extended to June 1st. I'm sure there'll be several questions on these various government programs, so don't hesitate to include your question for the Q&A section. So next, I'll pass the floor over to Ken, and he's going to walk us through a few more tax matters as well as some planning opportunities that might be available to us in the COVID situation we're in now.
Thanks, Chris. Well, the first thing, one of the biggest things we've been grappling with over this pandemic and was when they announced the wage subsidy, whether we would refer to it as Qs or SUs. So you just heard both versions. And I don't think we have any even consistency within it in M&P, but I refer to it as Qs, as does Chris. So I'm going to be talking about tax planning in a post-COVID Canada. The first thing you're going to want to look at is you'll have to review your owner remuneration strategy. Specifically with respect to the wage subsidy, you have to be very careful not trying to force owner-manager remuneration into Q's eligibility. For example, you can't retroactively switch from dividends to wages in order to get the pre-crisis remuneration you need to qualify. But certainly if you have been paying regular wages, or if you have, if the owner-manager has received a bonus in the pre-crisis period, you'll likely qualify if you continue to make payments of wages in the eligibility period. So make sure you look at that and take full advantage of Qs for owner managers and other non-arm's length employees. From a wage versus dividend perspective, we typically adopt a plan that works year after year, but rules of thumb apply to similar fact patterns, and in particular, rules of thumb with regard to remuneration apply to an assumption of a consistent level of income. With income being impacted and personal tax rates going up in 2020, you should revisit your remuneration strategy. I believe there's too many permutations to get into specifics. Just suffice to say that every client is going to want to test if their remuneration strategy is appropriate. The capital dividend account is a notional account that tracks the tax-free half of capital gains less the non-deductible half of capital losses, and provides for the distribution of funds on a tax-free basis to shareholders. The point of it is that if an individual has a capital gain personally, only half is taxable and the other half is tax-free. The same applies to a company, but without a mechanism to distribute the tax-free half to shareholders as a tax-free dividends, capital gains earned through a company would carry a bigger tax burden than if the capital gain was earned directly by the shareholder. The capital dividend account exists for this purpose. It's an outlet to distribute the tax-free half of the gain. The capital dividend account is calculated at a moment in time, and that is when you file an election, immediately prior to filing an election to distribute the funds. If the resulting downturn in the market has resulted in a devaluation of an investment portfolio or real estate or other assets, and that is going to result in a capital loss in the future, that capital loss will reduce your capital dividend account balance. So it may be prudent now to pay out, maximize the payout of a tax-free dividend before these losses that are triggered will erode the balance. So it's a probably appropriate time to look at the size of the capital dividend account and determine whether a capital dividend payment is a prudent thing to do. Asset or creditor protection is always something that should be on your mind, but particularly in an economic downturn, you should revisit your structure. As an example, you may want to consider segregating investment assets and real estate assets from operations. You should also reevaluate personal and cross corporate guarantees and protect yourself to the extent you're able. An estate freeze, in basic terms, is restructuring your personal holdings, shares of your corporation, and other assets to freeze the value of the assets at their current value, at their current fair market value, and divert future growth in value to your intended beneficiary. When you do this, you cap your estate tax liability. The most basic form of an estate freeze is exchanging common growth shares for fixed value preferred shares and issuing new growth shares to Generation 2, either directly or perhaps through a family trust, which might include Generation 1 as a beneficiary of the trust as well. And when you're doing a structure like that, it's really a case of having your cake and eat it too. The family trust structure offers you the ability to cap your estate value, or you can still, because of your you maintain an interest as a beneficiary in the trust, you can still continue to pay out future growth to yourself if that's what you want. And of course, with a trust, you maintain control of the corporation. A silver lining, if there is one, of an economic downturn is that likely the value of your estate is at a low point. So it's likely an ideal time to freeze your estate. If you've recently, if you've previously done an estate freeze, particularly recently when the values have been higher, you may want to revalue the shares of your corporation. If the underlying assets have less value than the redemption value set for the preferred shares you received in the freeze, these shares are now overvalued. If you just leave things as are, presumably the value of the company will recover and the preferred shares you received on the freeze will recover in their value. There is, however, an opportunity to recognize the diminished value of the preferred shares by exchanging them for common shares. That is the thaw. You're undoing the freeze you previously did. And then refreezing by swapping those common shares received for the preferred shares for new preferred shares with a lower redemption value. In so doing, you have reduced the value of your taxable estate. Other tax planning ideas aren't necessarily related to COVID, but they're equally as relevant at this time. First of all, before COVID, we were very concerned about the BC budget coming out, and there was an increase on tax rates. So now the tax rate on the top marginal rate on wages is now 53.5%. And the tax rate on regular dividends is 48.89, and on eligible dividends is 36.54. So that's quite an increase over the previous year. Tax advisors have been worried that, were worried in the past and are perhaps even more worried for reasons I'll get into, that some of the strategies we have been relying on will be under attack. In particular, we were worried that the federal budget would shut down capital gains strategies that allowed us to extract funds at lower rates than the dividend rates I referred to. The capital gain rate is 20 in BC. The top capital gain rate is 26.75%, whereas the dividend rates are 36.54 or as high as 48.89 in 2020. We were concerned that the federal budget was going to attack, in particular, that strategy, either through a rehash of previous rules they brought up back in the summer of 2017 and then walked away from, or through an increase to the inclusion rate on capital gains. Another silver lining is that the federal budget has been delayed in light of COVID. So those capital gains-based strategies are on life support. Now might be your last chance to take advantage of them. And lastly, with the benefits that have been paid out and the enormous deficit that's been created, tax advisors expect a very aggressive audit activity with CRA once they're back in operation. So my message would be to tread softly, to keep good records. They've had projects recently, for example, they were going after automobile benefits. So I would encourage you all to go through the effort of keeping a logbook, and I would be careful with other aggressive deductions, because we expect them to come knocking once this is all over. That's the end of my session. So I'll turn it back to Chris, and I'm not sure if Chris is going to moderate the Q&A or if,
Yeah, thanks, Ken. And thanks to Danny as well for his presentation. So now I'm going to open up the floor for our Q&A session and answer questions that may have been submitted as we went along here. Now, as
Chris,
a reminder...
Just before you do, there's actually just a point that I wanted to raise coming from your presentation when you were talking about deferrals of payroll taxes and other things. One thing that we've identified and employers, businesses need to consider is that recalling an employee from layoff, putting them using the SUS or the CUES program is not necessarily a cost-neutral activity, because there are payroll taxes, for example, the employer health tax, for example, workers' compensation, benefit premiums, and even vacation pay that need to be factored in. And I know that there are some industry initiatives underway with the provincial government to have the WorkSafe premiums and employer health tax premiums waived. Quebec, for example, as a province, has waived their WorkSafe premiums. But currently in BC, you have to consider that as an additional cost that wouldn't be covered. There are ways to cover the vacation piece, which I would suggest getting some advice on if that's what you're looking to do.
Great, no, that's perfect. Thanks, Danny. So just a reminder for everyone as we move into Q&A, if you do have a question that you haven't asked already, please enter it in the message board on the bottom of your screen. So let's move through the questions that we do have. Danny, I think this might be the first one for you. Dan asks a question: is there any additional provision for COVID-19 leave if someone claims that they can't work due to a weakened immune system and fear what the virus might do if they catch it?
Yeah, good question. Thanks, Dan, for that question. Dan and I work together, so we know each other well. Not an Employment Standards Act provision. It is not one of the protected grounds for a leave, but it is a human rights consideration. If someone has a weakened immune system, that may well be considered a disability under the Human Rights Act. Our Human Rights Commission has already identified that they consider COVID to be a disability. And therefore, I would suggest if that is what someone's raising, there's going to be a need to get some medical information to confirm what they're saying. And there's going to need to be an analysis of what an accommodation for that person looks like. A later recall, you'll have to give them some information on the measures in place to protect against the spread of COVID at the workplace. So it is a human rights consideration for sure. If someone's just overly cautious, it may well be it's not reasonable to refuse. They would need some medical basis for doing that.
Great, thanks, Danny. One more here likely for you from Naz. What about employees refusing recalls and not covered under the new section 52.12? Are they deemed to have resigned?
Yeah, again, a good question. I think let's consider the part that I just answered for Dan, which is the human rights analysis. Let's assume there's no human rights considerations here, and it's just someone doesn't want to come back to work. Maybe they're just worried, but there's no basis for it, or maybe they've found a better arrangement. Then I would be taking the position that they have, or they may well have abandoned their employment. I think you would be very well served by informing them Well, firstly, you recall them and you give them a time period, a reasonable period to accept the recall. If they refuse, I think you need to set out for them what the consequences of that refusal will be, so that there's a very clear documented record of having warned them that this is going to be the consequence if you don't come back. And if they continue to refuse, or they don't communicate with you, or they just choose to ignore you, then I think you can take a position that they've abandoned their employment. And I think the trigger that a lot of employees will get them off their bums, if you will, is that you will need to consider recoding their ROE from lack of work to resignation. And that will disentitle them to this CERB or EI going forward, and that may be an incentive, if you need to use it, for them to return to work.
Great. Another question from Dan. This one definitely speaks to the complications in the legislation of the CEWS program. So Dan asks that he believes Bill C-14 notes wages paid will qualify. Can we clarify if this is based on earned rather than paid in the qualifying period calculation? For example, many salespeople get paid commission, and there normally is a delay in physically paying those commissions rather than when they are earned earlier. So for CEWS, do we apply the commission earned during the qualifying period, even though they were not paid till later? Can I ask you to address this one for us?
Sure. So the subsidy, I'm actually looking at Bill C-14 right now. The subsidy relates to remuneration paid in the eligibility period, so March 15th to June 6th. And it refers to eligible remuneration paid in respect of that week. And so the words "in respect of" essentially imply it was earned in that week. So it's on an earned basis during the eligibility period. So if you had a commission that was earned prior to March 15th and paid after March 15th, it's not in respect of the week after March 15th. It's in respect of a period before March 15th. So in terms of the wages paid in the eligibility period, that would not qualify. In contrast, when you're looking at the pre-crisis remuneration period, which is from January 1 through March 15th, there is no in respect of test for that, so that is simply on a paid basis. So, for example, if you're looking at an owner-manager or arm's length employees for that matter, where bonuses in respect of 2019 were paid after 2019, so somewhere between January 1 and March 15th. Even though that payment, even though that bonus was in respect of 2019, it was paid between January 1 and March 15th. There's no in respect of test, so that payment meets the pre-crisis remuneration test. So it counts for pre-crisis remuneration, is on a paid basis. Post-crisis, March 15th and on, is on a earned basis.
Perfect. Thanks, Ken. I'll give a few seconds. That looks like the last question that we've got queued up here. I'll give a few moments if anyone else had anything else to add in. And if not, just wanted to let everyone know that we will be in touch sometime next week with a copy of the recording of this in case you wanted to refer back to any notes from this session. Definitely wanted to thank everyone for taking their time to come out and listen to the presentation today. And of course, feel free to reach out to any of Ken, Danny, or myself with any questions as we follow up after this session. Looking like there are no further questions, so I will just say that will be it. Thank you very much, everyone.